The global financial system is lighting up with the kind of warning signs that usually appear just before the broader public suddenly realizes what has been quietly forming for years beneath the surface. I'm recording this on January 24th at 7:49 p.m. New York time, and I want you to drop a comment telling me what time it is where you're watching from, wherever you are in the world, because the timing of this moment actually matters. Quick request before we dive in. I'm actively pushing back against copycat channels. If you find value in the work I do here, support the channel by subscribing and commenting. John AG. So the algorithm clearly understands who the real community is. Now here's the uncomfortable reality. When gold starts moving toward a level like $5,000, most people don't stop to ask what fundamentally changed. Instead they ask, is it already too late? And that question, more often than not, is exactly how people miss the next major phase of the move. Today we're going to unpack what's actually driving this surge, why silver is creeping closer to triple-digit territory, why industrial metals like copper are quietly positioning for their own shock, and why the headlines you're seeing right now are only scratching the surface of what's really happening underneath. And yes, I'm also going to challenge one popular bullish narrative that's circulating everywhere, because even in a strong bull market, not every optimistic story is accurate. Also, once you're done watching, check the description. I've added bonus links there, including access to a premium WhatsApp channel and a channel membership join link. Those are for people who want ongoing updates and deeper coverage without waiting for the next public upload. All right, let me set the tone with a single sentence that should unsettle you, at least a little. Gold's march toward $5,000 isn't random. It's a signal. The old rules are breaking down in real time, and the reason you can sense it is because everything that's supposed to feel stable suddenly doesn't. Currencies are shaking, governments are improvising policies on the fly, alliances are rearranging, and investors are starting to realize that safe was always more of a marketing term than a guarantee. The mainstream narrative loves simplicity. They tell you gold rises because of one dramatic headline, a conflict, a tweet, a diplomatic dispute, a sudden shock, and then they imply it's temporary. Relax, they say. Go back to your normal portfolio and let the professionals handle it. But reality is far more layered. Those headlines are often just the spark. The real fuel has been saturating the floor for years. So what is that fuel? It's debt that realistically cannot be repaid. It's deficits that politicians cannot meaningfully reduce. It's a bond market being forced to perform an impossible balancing act, funding massive borrowing while pretending the currency itself is rock solid. And it's a global shift where countries that once trusted a single system are quietly, patiently building alternatives, using one very specific tool, tangible assets. I wasn't alone in thinking through this today. I brought in two people who've spent decades inside the resource and capital markets world. One is a seasoned capital markets veteran who has lived through every major commodity cycle imaginable. The other is a dealmaker and longtime builder who tracks geopolitical strategy as closely as most people track sports. And I opened our discussion with the question everyone is thinking, but few want to say aloud. Are we witnessing the early stages of a new monetary era, or is this just another spike that eventually fades? They both agreed on one thing instantly. Price action is never random, but it is often misunderstood. When gold moves sharply, the crowd wants to pin it on a single cause. But gold behaves more like a report card. It reflects years of policy decisions and grades them in real time. That's why something unusual is happening. Even when certain alarming headlines cool off, the buying pressure under gold doesn't vanish. It pauses, it consolidates, and then it resumes pushing higher. Now let's address the $5,000 number because this is where comment sections start to split. Some people see $5,000 as the absolute top, like a hard ceiling etched into the universe, as if gold has a sticker slapped on it that says, "Do not exceed." But markets don't care about round numbers. What they care about is purchasing power. They care about confidence. They care about whether people still believe that paper promises will retain value while the issuers of those promises are buried under obligations. Here's a simple way to frame it. If a currency loses half its purchasing power, the nominal price of everything rises. Not because everything suddenly became more valuable, but because the measuring stick itself shrank. So when gold moves higher, the real question isn't just how high it can go. The deeper question is how far paper currencies can fall. And this is where things get even more intense, because this isn't confined to one country. It's global. We're watching multiple major economies run variations of the same playbook, spend more than they collect, roll the debt forward, hope growth bails them out, and if growth doesn't, weaken the currency and call it policy. That's the backdrop. That's the foundation under everything we're discussing. The second layer is something most people ignore because it sounds technical, but it really isn't. It's the plumbing. Specifically, settlement systems. For decades, global trade flowed through one dominant settlement pathway. You bought energy in one currency, you issued debt in one market, You held reserves in one set of assets. When that system is trusted, trade hums along smoothly. When that trust erodes, the world starts constructing bypasses. Those bypasses don't show up on the nightly news like a disaster. They appear quietly, like new rail lines being laid far from your city. Boring, easy to ignore, until one day you realize the trains don't stop at your station anymore. You've probably heard claims that a rising global power is stealing control of the gold price. Let's slow down there. Markets aren't stolen the way wallets are, but pricing power does migrate when physical demand grows and settlement hubs shift. If more trade flows through systems where actual delivery matters more than paper promises, then paper-driven pricing loses dominance over time. That doesn't mean the old system disappears overnight. It means it gets challenged, and that challenge shows up through persistent premiums, steady demand, and continuous flows. This is also where silver deserves attention. Silver is the metal that reveals stress before gold does. Gold is the general. Silver is the scout. Silver runs ahead, takes the first hits, and reports back what the battlefield actually looks like. So let's tackle the silver question that keeps flooding my inbox. If gold is the store of value, what exactly is silver right now? Silver is two things at once, and that dual role confuses people. It's money in the psychological sense, and it's a critical industrial material. When the industrial side tightens, demand can become price insensitive because manufacturers don't buy silver for comfort. They buy it because their products don't ship without it. And when the monetary side wakes up simultaneously, you get the kind of squeeze that makes people say, "How did this move so fast?" One of the most important points my guest made was this: if you're viewing silver as a long-term savings vehicle, gold might suit you better. If you're viewing silver as a volatility amplifier, silver itself may be the better fit. That's not advice, it's a framework. Silver can double quickly in a hot phase, and it can get cut in half when speculative excess washes out. So how do you choose? You choose based on your objective. If your goal is preserving purchasing power through currency instability, you prioritize stability. If your goal is capturing upside from underinvestment, industrial necessity, and monetary repricing, you look for torque. And silver has torque. Here's the part many people miss. That torque can be expressed either through the metal itself or through the companies that produce it. This is where arguments break out, because the metal-only crowd hates stocks, and the stock-only crowd mocks physical metals. Meanwhile, the smarter approach is often a blend, because the right vehicle depends on what you're trying to achieve. We talked about this in depth. When a metal's price rises, miners can behave like a lever, not because they're magical, but because costs don't scale the same way revenues do. If a company produces an ounce for $30 and sells it for $40, it earns $10. If it sells that same ounce for $80, it doesn't earn $20, it earns $50. That's why when miners finally get repriced, it looks like they woke up overnight. In reality, the math was always there. The attention wasn't. Before you rush into anything, there's a trap you need to avoid. Not all miners are created equal. Some have excellent deposits, but terrible leadership. Some have strong leadership, but operate in risky jurisdictions. Some have healthy margins, but weak balance sheets. Others are pure story stocks that live and die on sentiment. So when someone asks me whether they should buy silver miners instead of silver, the honest answer is that it depends on your risk tolerance, your time horizon, and your willingness to do real homework. And yes, the homework matters. This is a market where crowds often buy the wrong thing at the wrong time and then declare the entire thesis broken. Now let's talk about the uncomfortable question. When do you sell? Because once a bull market becomes public, pressure builds. Your neighbor becomes an expert. Your cousin starts sending charts. Your feed fills with guaranteed targets. That's usually the danger zone. One of my guests put it perfectly. The top isn't a number, it's a mood. When everyone wants exposure. When people who never cared suddenly feel intense fear of missing out. When the conversation shifts from, should I own this, to how can I borrow to buy more? That's when trimming becomes a consideration. That mood doesn't appear at $5,000 simply because it's a big round number. It appears when the crowd believes price declines are impossible. So what would actually make a long-term gold holder think about selling? We outlined real conditions that would matter: a credible plan to balance budgets without financial repression, sustained positive real yields where currencies pay more than inflation erodes, political commitment to addressing long-term obligations honestly, and broad public adoption where gold is no longer niche but fully mainstream. Those conditions are rare. That's why long-term holders often don't exit entirely. They rebalance. They take profits during emotional peaks. But they don't abandon the hedge because the hedge exists for the environment we're moving into. I can already hear the comment, okay, John, but what if government seize gold? It always comes up, and it should. Governments have done it before. But here's the nuance most people skip. Direct seizure is messy, political, and dangerous. Inflation is cleaner. Regulation is quieter. Taxation is easier. So is it possible? Yes. Is it the most likely path? Historically, no. The more common path is the stealth tax, where your currency buys less every year while you're told things are improving. So don't prepare for the movie version. Prepare for the slow erosion version. Now let's shift to copper, because I promised something beyond gold and silver. Copper is where the next shock is hiding. Copper is the backbone of electrification. It's in grids, motors, charging infrastructure, data centers, anything that moves electrons. And here's the problem. Copper supply takes time. You don't decide today and produce next year. It can take a decade or more to discover, permit, finance, build, and ramp a mine. Demand doesn't wait for permits. When supply growth can't keep pace, price becomes the balancing mechanism. And in copper, that balancing can be violent because copper is a working metal. Scarcity hits entire production chains. The bullish copper thesis is straightforward. Decades of underinvestment plus rising complexity plus rising demand equals structural tension. But here's the honest counterpoint. Not every copper story is equal, and not every demand forecast plays out as slide decks promise. A major global slowdown can still hit copper hard in the short term, even if long-term shortages remain. You can be bullish long-term and respectful of volatility short-term. Both can coexist, and that matters because most losses come from poor timing, not wrong theses. The discussion then moved to something even bigger, the idea of a reset. When people hear reset, they imagine an overnight switch flipping, new currency, new system. Everyone wakes up in a different world. That's possible, but it's not the only path. A reset can be gradual. It can be a series of adjustments that slowly reprice assets and rewrite incentives until old assumptions quietly stop working. If you want to spot a reset in progress, watch actions, not speeches, watch reserve behavior, watch settlement systems, watch commodities priced in new units, watch which assets are accumulated quietly, even when headlines say they're irrelevant. That leads to the recurring question. Do some countries hold more gold than they admit? It's possible, and it wouldn't be shocking. Reserves signal power, and signaling creates leverage. But here's the skeptical lens. Announcing early raises your own purchase price. Announcing late loses narrative advantage. So if hidden accumulation exists, it's likely revealed only when the strategic objective is complete. We circled back to silver again, specifically export controls and industrial demand. Silver plays a critical role in solar, electronics, and high-efficiency technologies. Many underestimate how embedded silver is in energy transition hardware. Substitution isn't always simple. Manufacturing changes are expensive, and reliability matters. If silver represents a small cost in a high-value product, demand can persist even at higher prices. But we also need balance. Technology evolves, recycling improves. If prices spike too far, engineers respond. The bullish silver story is strong, but it's still a market, not a belief system. Geopolitics entered the discussion next, and this is where things get real. Geopolitics doesn't need to end the world to move markets. It only needs to inject uncertainty into trade, energy, and alliances. Uncertainty fuels hedging. A lot of headlines are theater, but theater has consequences. Even talk forces businesses to plan, shipping contracts to reprice, insurance to adjust, and defense budgets to shift. One guest made a powerful point. You can win individual fights, but you can't fight everyone and expect stability. When leadership becomes unpredictable, markets hedge unpredictability. And the classic hedge is hard assets. Let's address the too late mindset directly. If you're buying gold to flip it next month, that's a different game. But if you're buying gold because you distrust long-term currency stability, too late is the wrong framework. You don't buy insurance after the fire starts. You buy it before you need it. I want to pause and do something for the community. If anyone here has improved their finances, built a business, paid down debt, or leveled up their investing journey because of ideas discussed on this channel, share your story in the comments. It motivates others and proves progress is possible. Now let's talk flows, because markets move on flows, not feelings. Official sector gold buying has been one of the most consistent and misunderstood forces in recent years. Even when quarterly numbers fluctuate, the intent is clear. Diversify reserves away from assets that can be frozen, sanctioned, or inflated away. Central banks don't chase candles. They build positions slowly and quietly, and they still treat gold as monetary, even if Western investors forgot. Look at the bond market too. High nominal yields don't automatically kill gold. What matters is real return after inflation, taxes, and currency risk. A 5% yield sounds great until your purchasing power erodes faster. When debt loads are massive, credibility becomes fragile. Governments rolling trillions annually are tempted to keep conditions easy. That tension between debt management and price stability is where gold shines as a pressure gauge. Now let's discuss paper versus physical. This isn't conspiracy, it's structure. Paper markets prioritize liquidity and leverage. Physical markets prioritize delivery and ownership. In calm times, paper dominates. In stress, physical tightness matters. That's why you sometimes see calm futures prices alongside elevated real-world premiums. The screen price doesn't always decide the final outcome. Here's another trap. Assuming opportunity is gone because a move already started. Big shifts unfold in phases. Smart money positions first. Price moves next. Media notices after that. The public arrives last. That last phase is loud and dangerous. Where are we now? We're not at peak public participation. You can tell because gold is still treated as strange, silver as a meme, and savings accounts as safe because a number appears on a screen. When the public truly arrives, no convincing will be needed. Another piece tying this together is currency fragmentation. A dominant reserve system made trade efficient but concentrated power. When that power is used aggressively, alternatives become attractive. That's why we're seeing bilateral trade deals, local currency settlement experiments, and renewed interest in neutral reserve assets. Gold fits that role because it has no counterparty risk. It doesn't rely on promises or networks. It simply exists. But let me challenge one claim. A full gold-backed currency tomorrow? Unlikely. A modern credit economy makes that difficult. More likely is gold playing a larger indirect role as collateral, reference, settlement bridge, and confidence anchor. Here's the next layer many miss. Energy. Energy underpins everything. Rising energy costs squeeze margins, strain supply chains, and trap central banks. That's why energy matters even for precious metals investors. It feeds into mining costs, industrial production, and inflation. This is why planning matters more than prediction. A plan that only works in perfect conditions will fail. A resilient plan survives messy outcomes. Think in buckets. 1. Liquidity for real life. 2. Resilience assets like precious metals. 3. Productive risk like quality miners or commodity-linked businesses. And if you've already built success, share how you did it. Your story might keep someone else from quitting. In the next section, I'll explain why the "this is just a geopolitical spike" argument is dangerously incomplete. Now we have to address Bitcoin. You can't talk about new money without it. Bitcoin is a phenomenon, but its narrative constantly shifts. Digital gold, risk asset, payment rail, treasury strategy. The issue isn't Bitcoin itself, it's narrative cherry picking. Pumps are digital gold, dumps are early tech, correlation becomes adoption, decoupling becomes store of value. That flexibility is both powerful and risky. The loudest claim is replacement. Bitcoin will replace gold. That's a stretch. Gold has thousands of years of history and cultural acceptance. Bitcoin has network effects, but also regulatory exposure and technological dependence. Both can coexist. They may serve different roles under stress. Stablecoins add another dimension. They extend currency dominance onto digital rails, creating demand for backing instruments and influencing liquidity. But they also introduce fragility through issuer trust and regulation. If you're watching the chessboard, watch digital currency infrastructure closely. Here's something rarely said plainly. Money is largely confidence. Confidence that rules won't change. Confidence banks open tomorrow. Confidence bonds repay something meaningful. When confidence erodes, people don't riot. They rebalance. And that's what you're seeing in metals. We had a viewer in their 70s ask about selling metals for retirement expenses. This deserves a human answer. If you need cash, but you also need a plan. If purchasing power declines over the next decade, fixed income becomes harder. The answer isn't panic selling. It's planning, budgeting, and resilience. Some liquidity, some hard assets, some inflation-adjusting income. Depending solely on a pension and assuming perfect preservation is a gamble. Not because of bad intent, but because math eventually overrules politics. That's why we offer members-only content with deeper research, charts, and analysis. The join link is in the description. Where does gold go from here? I won't give you a magic number. Anyone who does is selling entertainment. But here's the framework. Gold preserves purchasing power over long periods. If you wait for permission, you won't get it until it's obvious. Fiat currencies lose purchasing power over time. If volatility, geopolitics, and policy experimentation increase, it's reasonable to expect gold to reprice nominally. History doesn't repeat, but it rhymes. When trust breaks, gold rises. Here's the final cliffhanger. If gold is repriced as a reserve asset, other scarce commodities follow: energy, industrial inputs, strategic minerals, and the businesses tied to them can outperform in ways that feel irrational if you're stuck in old narratives. So let me ask you this. If gold hits $5,000 and silver hits $100, what does the average person do first? Panic, celebrate, or ignore it until it's too late? And if you had to choose one metal for the next 2 years, would you choose gold's stability or silver's volatility? We also touched on platinum group metals. They matter, but they're specialized, cyclical, and speculative. Treat them accordingly. Before we close, one last reminder. Share your wins, they matter more than you think, and check the description for bonus links. Here's the final thought. Markets don't wait for the average person. They move based on institutions, governments, and structural forces. The biggest risk right now isn't volatility, it's complacency. Complacency is how you wake up one day and realize the world changed while you assumed it wouldn't. Zoom out, build a plan. And if you want more content like this, subscribe, like, and drop your thoughts below. This is not financial advice. I'm not your advisor. This is educational content based on opinions and general information. Always do your own research and consider your personal situation before making any investment decision.